Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures kicking off the week in positive territory. Investors are looking ahead to a busy week of data and Fed speak. Key events include Tuesday's JOLTS report, which is expected to show a decline in job openings, and Friday's non-farm payrolls print. But the latter report could be delayed if the government shuts down. And speaking of which, the clock is ticking for Congress to reach a deal on a short-term spending bill. The top four congressional leaders from both parties will meet with President Trump at the White House today. If they cannot reach an agreement by midnight tomorrow, federal funding will expire. These discussions today will be the first between Trump and congressional leaders ahead of the deadline. And Electronic Arts going private in the biggest ever leveraged buyout. The company agreed to sell to a group of investors in a deal that values it at $55 billion. Founded in 1982, EA is one of the world's largest independent video game publishers. The company makes games including EA Sports, FC, and The Sims. Let's get a check on stock futures right now. We are seeing some strength here after the rocky week last week for stocks, particularly for large cap tech, but it's coming back today. The NASDAQ indicating a gain of almost 0.75% at the open, the S&P pointing to a gain of more than 0.5%, and the Dow rising nearly by that amount. So let's dig into our top stories of the day. Stocks are looking to rebound after a losing week, and possible government shutdown just days away. Plus, new tariffs are set to take effect this week on pharmaceuticals, furniture, heavy trucks, and now foreign-made movies. President Trump just saying that in a post on Truth Social moments ago. Joining me now, senior reporter Ali Canal live at the NASDAQ, Federal Reserve correspondent Jennifer Schottenberger, and Steve Clemons, the Washington Note founding editor. Thank you all for being here this morning. Steve, I actually want to get to you first on the notion of this government shutdown here. We're trying to figure out if it's going to happen, what the effect is going to be. What's the word there in Washington? What are the tea leaves telling us?
Tea leaves are saying government shutdown is coming, even if behind the scenes it's a kabuki act, because Democrats caved last time, in the eyes of many, that they agreed at the last moment. And many of their base said, what are you standing for right now? And so even though I think Senate Majority Leader John Thune and others have reached out proactively early in this case, there's a lot of pressure on Chuck Schumer and the Democrats at large to show that they can resist President Trump's unwillingness to sort of, continue to subsidize Obamacare and to come around on this. So right now, it's looking like a shutdown no matter what. What is, I think, up in the air is how long and serious it will be. That's the tea leaves.
And in terms of whether the Democrats are going to be able to get any of these kinds of concessions from the administration or the GOP, any indications? I mean, there is some bipartisan support, right, for, in terms of healthcare spending, no?
Absolutely. I mean, there is a very big meeting in the White House today of the Senate and House leaders, both parties, coming together with President Trump, who's meeting them all. And we'll see if a miracle or if a rabbit gets pulled out of the hat here. But right now, the big issue that the Democrats are drawing the line on are Affordable Care Act subsidies and the chance that, come January 1st, many Americans will see the prices that they're paying through the ACA exchanges nearly double or more in price. And so that's what they're drawing the line on. And there hasn't been much move from the White House towards that. But as I said, there are other dynamics at play, and it really has to do with the moment of people wondering, what is the Democratic game plan of dealing with this White House on a number of fronts? So this may be a shutdown that's really beyond focusing on a specific policy area, which makes it difficult to come to a consensus in the White House. But again, you always see brinksmanship, and brinksmanship usually comes with a very last minute deal. And that could hold out. But there's so many drivers of this particular shutdown, and the dynamics have nothing to do with policy, that I think many people are betting the shutdown happens no matter what.
Yeah, and obviously, Jennifer, there are a lot of economic implications, but there are also implications for the markets the markets don't usually react to shutdowns. Let me just put that right out there. However, we could see perhaps a delay of some very important economic reports, and that could affect the markets.
Yeah, absolutely. We've got that key jobs report out this Friday. Depending on how long this shutdown occurs, that could get delayed. And if it's delayed long enough, that could create problems for the Federal Reserve that uses that key data to make informed decisions, right? They're very worried about the labor side of their dual mandate. But I think it's also important to point out that the stakes of a government shutdown this time around are much higher. And that is because President Trump has threatened to lay off a very large swath of the federal government workforce. We're already expecting to see those who were cut loose or given a deal for 8 months severance roll off the government payrolls here soon. And if the government shutdown does occur, White House Budget Director Russell Vought has already directed federal agencies to make plans for mass layoffs. If they follow through with that, that's going to have large implications for the economy itself. Of course, we also are going to see people furloughed. We've traditionally seen that as part of a government shutdown. How long this shutdown lasts is another question, and economic implications for that. And I just want to remind viewers that the last time Trump was president, we saw a government shutdown, and it was the longest in history.
So, Steve, do you think that they will follow through on these threats to permanently cut workers? And if that happens, who owns that? Which party?
Well, look, it's very hard to see who owns it in the end. That'll be a function of how the public sees, its government. But here the White House is basically saying we're holding our own workers who are delivering various services hostage to this deal, and somehow painting the Democrats as the ones that are holding all these federal workers in place. It's a very odd thing, but I think one thing we've learned in this is, President Trump, he bluffs sometimes, but not on this kind of front. And so I agree that if the shutdown does happen, I think they're going to use it as another excuse to lay off more workers. May not be as big as they are indicating, but a sizable one. But I suspect that is going to be tried either now or later anyway. This administration is very bent on shrinking the federal workforce further. And as we just heard, as you see the people that are going off the rolls after 8 months of the 8-month support that they received, I think a second wave of furloughs, or I should say second wave of layoffs, is most likely coming again as bureaucracies and agencies essentially whittle down their workforce under guidance from the president. So this is a cause that gives them excuse, but I don't think it is the end of the story if they don't shut down the government. I don't think all these people keep their jobs either. Yeah,
it's still an underlying desire of this administration. Allie, all of this said, markets are doing just fine this morning, thank you. We're seeing this bounce back in technology in particular.
Right, market's doing just fine. And to your point, Julie, if history is any indication, when the government shuts down, it doesn't have long-term impacts on stocks. Although there have been words of caution on Wall Street that we could see maybe short-term blips of volatility. But overall, things seem pretty good out there right now. We just had Goldman Sachs upgrading equities to overweight. They are bullish at the end of the year. They're pointing to a resilient U.S. economy, Fed easing, policy support, calling this a late cycle slowdown with a safety net. They do see the S&P 500 climbing another 2% to around 6,800 over the next few months, and says that they would buy any dips along the way. But I alluded to that word of caution there. And Evercore ISI is saying that the S&P 500 is priced to perfection and could see a pullback before the end of the year. Lori Calvasina from RBC Capital Markets, she was just on a trip internationally in London, and she said traders there are talking about stretch valuations, whether or not the AI bubble could burst. And that's been more of a conversation we've been hearing, whether or not we are in bubble-like activity that's largely been shut down at this point because we have earnings that have supported these levels, at least for now. And that's why the upcoming earnings season is going to be so crucial for the longevity of this stock market rally. Still, though, volatility might pick up through October, through the end of the year. Because of that, you are seeing gold rally to a record high. There's a few different reasons for that. One is the weaker dollar. We know a weak dollar tends to raise import prices and add upward pressure on inflation at a time when we are seeing tariffs continue to work their way through the system. We will be seeing more of those tariffs rolled out later this week, and that adds just yet another level of price uncertainty to the mix. And then on top of that, those shutdown risks that we've been discussing all morning, just fueling that greater demand for safe havens and boosting gold's appeal as both a hedge and a safe haven asset. Beyond just gold, there's also different types of hedging, like the Russell 2000, for example, with those expected Fed cuts, along with maybe some retail names as well that I was seeing cited by analysts. But overall, there is this expectation that the rally party can keep powering on here.
Ali, you mentioned tariffs, so we got to get into that as well. And Steve, I want to go to you on this and on the president's Truth Social post that just came out in the last few moments, where he said, I will be imposing a 100% tariff on any and all movies that are made outside of the United States. This is something he's teased before. And leaving aside the idea that, like, the other stuff that's tariffed is physical stuff that comes across a border, and Customs and Border Patrol tariffs it when it comes across. A movie, like, it doesn't quite work in the same way. So I don't know if sort of how technically how that's going to work. Leaving that aside, Steve, what's your take on all of these tariffs that are set to go into effect this week?
Look, I think President Trump, as we know, loves tariffs. I think it's his favorite word. And what is making the industry, and I think a lot of small businesses in particular, just reeled from this, is the uncertainty, the dramatic, erratic nature of the discussion and imposition of tariffs, and the way they're up, the way they're down, the new categories. There are some very, very good people in the Trump administration, I should add, that I know that work every day on trying to make the new tariff world stable, sound, predictable. But there's a dimension to the White House role, which is making this erratic and flamboyant. And it's really impacting small businesses across America and small businesses that are export. You know, a lot of the big businesses are going to find ways to get exempt from this, but they're not the backbone of the U.S. economy, small businesses. And as you kind of look at movies and whatnot, you ask a very important question. What's the regulatory world for that, right? In which we've moved to a hyper-connected digital world that now we are disaggregating and we're pulling apart and we're putting, confines in. I think it's going to be not only tough to do, but it injects uncertainty into that economy. I love the profile of what our colleague just shared about how good everything looks right now, but it's all good until something triggers a crash. And if there is something out there that begins to trigger some seizure in the markets down the road, it's going to be, oh my gosh, what have we done to small business? Oh my gosh, what have we done to the regulatory state? What do we do? Where's America going right now, pulling away from global markets? That can't be good for the market profiles we've just seen.
Jennifer, Steve, Ali, thank you so much. Really appreciate it.
Thank you.
Coming up on Morning Brief, we bring you today's top trending tickers as we count you down to the opening bell. Don't go anywhere. Now time for some of today's trending tickers. We are watching EA, CSX, and pot stocks. First up, we got EA, the video game maker, agreeing to sell itself to a group of investors in a deal that values it at $55 billion. It marks the largest ever leveraged buyout, the biggest deal of the year. Founded in 1982, Electronic Arts is one of the world's largest independent video game publishers. The company makes games including EA Sports, FC, and The Sims. Next up, CSX, the Rail Giant CEO abruptly departing the company. The exit comes as CSX faces pressure from an activist investor and rising competitive challenges. Rival Norfolk Southern and Union Pacific, they struck a deal earlier this year to create the first ever transcontinental railroad in the U.S. Steve Angel has been appointed as the company's new chief executive, effective immediately. And finally, we got pot stocks getting a boost from President Trump. Over the weekend, the president posted a video on social media that touted the medical benefits of, quote, hemp-derived CBD for seniors. Shares of Tilray, Canopy Growth, and more moving after that post. Trump had said last month that his administration was looking to reclassify marijuana, which could also result in potentially easing criminal penalties around its use and also around financial activities tied to its business. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Goldman Sachs analysts shifted overweight on stocks for the next 3 months and 12 months, writing, quote, good earnings growth, Fed easing without a recession, and global fiscal policy easing will continue to support equities. As we prepare to head into the fourth quarter, should investors still be looking at mega cap tech names like the Mag 7? Joining us now is Glenn Dorsey, Clark Capital SVP and Head of Client Portfolio Management. Thanks so much for being here. So we're setting up for the fourth quarter. We've had this, what some have called a melt up in stocks, Glenn. You have some bullishness still out there. What do you think the setup is looking like?
Well, I think stock prices have really been following earnings. We've had some incredible earnings reports coming out. Expectations for the rest of this year are very solid. and into next year as well. We've seen profit margins go up. So we've had a really resilient business cycle, and the economy continues to be strong. So in our mind, the multiple has expanded, but it's not really unreasonable in terms of where the valuations are, given what the growth is.
And so do you just sort of keep all in, and do you keep all in on large cap tech in particular?
I think you want to be invested in large cap tech over the long haul. I think small cap is also very interesting now because of the valuation differential being 30% cheaper than the S&P with declining interest rates. But you have to manage your position sizes as well to control risk. If things are outsized size in your portfolio, you might want to cut back.
I mean, there's also sort of this ongoing discussion about those so-called Magnificent Seven. We love our neatly packaged big cap stocks here on Wall Street, right? And so there's been a discussion about whether it's a useful moniker anymore, whether we need to sort of expand and edit, right, the Magnificent Seven. What do you think? When you think about that basket, what do you think investors need to have in there?
I think inevitably it's going to expand. I mean, as you have the data warehouse build out, there are so many companies that would be, in our opinion, be able to benefit from that. You're going to have, engineering, construction, equipment, all the different chips, GPU, CPU, memory, tremendous amount of power being generated to power those plants as well, and transmitting it, and cooling. These are all big areas that are kind of tangential to the AI build out. But then as companies start to deploy this, in our opinion, you see a profitability tailwind from companies, getting the boost from AI.
So it sounds like it'll be sort of a rolling situation here. So when you go into the latter part of this year and going into next year, sort of how active do you need to be in that portfolio management?
We're always a fan of active management. I think sticking with high quality companies gets you through different cycles. We've gone over 100 days without even a 2% pullback in the market, so would not be surprising to see some choppiness along the way. But as long as the underlying fundamentals, which are earnings, and earnings drive the value of companies, are solid, we think the long haul should look pretty good.
I'm also curious about small caps, which have sort of come back into the conversation as of late, Glenn. But I mean, they hadn't really gone anywhere because we've had people consistently calling for small caps to come back, and they haven't quite done it. What's different now? Is it just the Fed cutting rates, or is there something else?
I think that's part of it, and you're starting to see earnings hook up. But if you look at the small caps, they've actually outperformed the S&P since the April 8th lows. So it's kind of been a stealth rally in small caps, and we think it has more legs.
And again, getting to the backdrop here, we're hearing from a lot of Federal Reserve governors as of late. Beth Hammack, for example, speaking this morning at a conference in Europe, and she said she's still worried about inflation. We're coming up on a week where a number of new tariffs are going to be going into effect. So do you just avoid those tariffed areas entirely? And do you share a concern about that effect in a broader economic way?
Well, the tariffs are, as we all know, kind of a moving target, so it's sort of hard to avoid all of them. We went through this in 2018 into 2019, and we, with tariff war with China back then, and we actually saw CPI go down. At the same time, leading up to the pandemic, the S&P was up almost 25%. So I think you really need to think about how companies are doing. How much are these tariffs actually going to impact them? There will be winners and losers, which goes back to the earlier discussion about active management and trying to steer clear of the areas that are going to be hit the hardest as these tariffs move forward.
Glenn, thanks so much. Appreciate it.
Thank you.
Coming up on Yahoo Finance Opening Bid, our executive editor, Brian Sozzi, also the host of that program, is joining us now. Soz, what's coming up?
Yeah, double duty, Julie. Of course, we're going to dive more into the risks to the economy from a potential government shutdown. And to that end, we'll welcome on Joe Lavorgna, has been on many times over the past few years. Counselor to Treasury Secretary Scott Bessent will ask him his views on the economy and where he thinks it is all headed.
That should be quite interesting. Thanks so much. Appreciate it, Soz. That does it for Morning Brief. Much more ahead on Yahoo Finance. Stay tuned.